President Trump wants negative interest rates? So, like usual, it's never a dull moment when President Trump tweets. And supposedly there's been, I think, 10,000 tweets he's put out in the last 12 months, some ridiculous number. JP Morgan's actually tracking it, and they have a new Volfefe index, Volfefe. It's supposed to be a riff on the Covfefe typo. So it tracks his tweets in relation to the bond market. It's some type of hedge fund product. So if you're not aware, President Trump on 9/11, in addition to, the normal 9/11 remembrance tweets, he actually early in the morning, I think it was at 6:40 a.m., he started 6:42 a.m., he put out two tweets. Quote, "The Federal Reserve should get our interest rates down to zero or less, and we should then start to refinance our debt. Interest cost could be brought way down, while at the same time substantially lengthening the term. We have the great currency power and balance sheet." And then here's his second tweet. "The USA should always be paying the lowest interest rate, no inflation, an exclamation mark. It is only the naivete of Jay Powell and the Federal Reserve that doesn't allow us to do what other countries are already doing, a once-in-a-lifetime opportunity that we are missing because of, quote, boneheads," end quote. So only if life were so simple that central planners and central bankers and government bureaucrats and highly elected politicians could perfectly allocate capital. But the reality of the situation, we know this through history, is that it doesn't work out very well. And President Trump, I think he's drawing on his background when he was private citizen, commercial real estate developer Trump, where his philosophy was literally bigly. It was go big or go home. In fact, if you don't believe me on that, after Art of the Deal, he put out another book that said, think big. That everything he does, he doesn't do things in careful measurements normally. It's all in. He pushes all of his chips in. As a commercial real estate developer, when the banks offered him certain credit lines, he didn't take a quarter of it. He didn't take a third. He didn't take a half. He took it all and tried to leverage it up and build and make that cash flow, get that building up and done, get it generating cash flow, pay back the loan, and do it all over again. And sometimes this worked, and sometimes this failed spectacularly. But Trump was allowed to, even if he went bankrupt, and I know people that went bankrupt in the financial industry. Jim Rogers and other people have talked about this. Jim Rogers was shorting stocks on margin when he was a younger man, and he mistimed the timing of a trade. He ended up being right about the fundamentals, but he screwed up the timing, and because of the margin, he didn't have the money for margin to keep paying the margin calls, and he ended up having to go bankrupt once, I think at least once. And some other professional traders have had to go bankrupt more than once. And normally most adults, especially people here in the US, yes, bankruptcy is easier here in the US unless you have student loans, but normally most of the people who go bankrupt once or twice, their financial situation is normally never good. So Trump is one of those rare exceptions that has bounced back time and time again from bankruptcy, and it hasn't totally destroyed his brand or his ability to raise money or his ability for the banks to give him money. This is actually very common for the commercial real estate. So I think Trump, with these tweets, he's talking about what he used to do. He's drawing on his life experiences as a commercial real estate developer, where he was always very aggressive. So he would not, if the bankers offered him, let's say, a couple $100 million credit line, he would not build a building for a quarter of it. He would, and then pay back the loan, do what a more prudent real estate investor would do, which is use some of your credit line, build the building, get the cash flow, pay back the loan, repeat. Kind of like Monopoly, how you have one building here, you have one house, two houses, three houses. You don't build them normally all at once. You pay back your debt. And that's not how Trump did things as a private citizen in his commercial real estate career normally. It was normally think very big. How much credit are the bankers offering him? Well, the max. Let's take out the max. Let's go for it. So I think that's translating into his philosophy now. So today, the European Central Bank in addition to Trump's tweets, and by the way, guys, Trump also today, he tweeted out a tweet criticizing the Fed again. He criticized them, saying that the European Central Bank, let me pull it up here. I'm scrolling back up on Trump's Twitter. There's so many tweets here. Okay, let me get back up to the ECB tweet from earlier today. He was actually saying good things about the European Central Bank and their rate cut, which is funny because any expert I talk to about that says the European Central Bank with their negative interest rates, their rate cuts, their QE, it's a disaster. That the pension funds, the insurance companies, the banks, the savers, all those entities in the European Union, they're all worse off because of the policy that the European Central Bank has done. Okay, here's his tweet from 13 hours ago earlier today. The European Central Bank acting quickly cuts rates 10 basis points. They are trying and succeeding in depreciating the euro against the very strong dollar, hurting U.S. exports. Actually, if you look at the dollar index, President Trump, let me pull that up really quick. The dollar index actually did not fall much. It's still above 98. The dollar index, guys, is still holding above 98. Because if the euro is trying to weaken, guess what? The dollar index is mostly made up of the euro. So if they're trying to weaken the euro, that means they're helping prop up the dollar. That means the dollar is going to be strong. Okay, let me continue with the rest of his tweet here. In depreciating the euro against the very strong dollar, hurting U.S. exports. Okay, it's way oversimplification, and the Fed sits and sits and sits. They get paid to borrow money while we are paying interest. So he doesn't want to pay any interest. He wants to go, as I read from the tweets yesterday, he wants to borrow as much as he can, refinance the debt, and borrow as much as he can, maybe on infrastructure or something like that. So there's a lot of news stories that are corresponding to this. In addition, before this Trump tweet, it looks like, and I covered this in the last couple days, we have a big unwinding, guys, of the Stanley Druckenmiller betting on zero interest rate policy ZIRP trade. A lot of these hedge funds probably, I don't know if Stanley Druckenmiller levered up because he's already a billionaire, but these hedge fund copycats who copied Stanley Druckenmiller after he revealed that trade, they levered up those trades on the treasuries, betting on zero interest rate policy on the 10-year U.S. Treasury yield, and we've had a very big spike in the 10-year U.S. Treasury yield, which is interesting because today we had a 30-year Treasury auction, and the yields were actually low. The 30-year Treasury paper sold at a yield of 2.270%, which, while below August 2.335%, and the lowest since July of 2016, tailed the when issued 2.254% by 1.6 basis points. So the third consecutive ultra-long auction that has tailed, and the second in the last 7. So the 10-year Treasury auction this week, I think, was mediocre, but apparently the 30-year one seemed to be better. Interesting. So the U.S. Treasury sold $16 billion in 30-year paper today in an auction that was in many ways a carbon copy of yesterday's benchmark sale. So there wasn't a big spike in yields there. But let me talk about the big spike in the 10-year U.S. Treasury yield. So on September 3rd, only 9 days ago, the yield on the 10-year U.S. Treasury was at 1.444%. That's the lowest it's been in a while. I think almost 12. Let me look at a long-term chart here. I'll look at a long-term chart after. So we went in 9 days. We went from 1.444 up to 1.791. So to me, that shows that there's a big unwinding of that trade. That what people were copying Stanley Druckenmiller. People are unwinding the leverage. They're taking at least some, maybe all, of their profits off the table. And a lot of that has to do with, like I said, how much in U.S. Treasuries has to be sold. Zero Hedge put out an article that's echoing this, that the U.S. budget deficit already hit $1 trillion for 2019, and we still have one more month left in the fiscal year. So there's still more money to be raised. Remember, I talked about how the U.S. Treasury, the estimates are at least $814 billion, and that's probably in the low end is going to be raised by the end of 2019. Probably going to be a lot more than that. So we've already run a $1 trillion budget deficit with one more month left in the fiscal year. If you want to read that whole story, I'll put a link in the article. Let me take a look at a longer term chart here for the yields on the 10-year. So in 2016, we got to 1.366% on the 10-year. But other than that, it looks like the 1.444 from September was probably the lowest it's been. And it looks like the 1.44 was only there for a very brief time, because on a longer term chart, it only shows 1.459. So it was only probably at 1.444. The very lows, that was probably the very bottom spike low before a lot of the selling of the trade occurred. So the ECB did cut rates today. It was, let me look up some articles on this. I have them up here. It was the first time they've cut the key rate since 2016 as the recession fears grow. Mario Draghi claims that it was a unanimous decision. There's articles that it was a lie, that wasn't a lie. It was not a unanimous decision. He cuts the deposit rate minus 0.5%. My God, it's just ridiculous what the central banks and the European Central Bank has done. And now Trump wants the Fed to copy the European Central Bank. He definitely does not understand the damage that has been done to the European Union by the European Central Bank with their policies. Definitely does not understand. And that brings me to a question from a listener who put this in the Wall Street for Main Street Facebook group and also a Patreon account contributor. Thank you, David DeForest, one of my almost 150 Patreon account contributors now. I think we have 140 the last time I checked earlier today. So it's really growing very quickly. Thank you guys very much. He asked a very good question. He says, if President Trump does get his way, how would this affect pensions? Well, pensions are a disaster already. Certain pensions are in more trouble than most. They're further along in the problems. So the pension funds in Illinois, the pension funds in California, those pension funds in the Democrat states, so New York, New Jersey, Michigan, Illinois, and California seem to be in the worst shape, although there are pension funds in Republican areas that have had problems as well, although in general the trend is that most of the Democrat states have the worst ones. And the pension funds, the politicians in those states, they straight up lied. So in order to get votes, they promised these teachers, they promised these firemen, they promised these government employees, these policemen, they promised them enormous salaries, very comparable to their last highest salary as government workers. I think 80% for some of these pension funds. So 80% of their salaries once they retired for the rest of their lives, plus Cadillac healthcare and other perks. And it's just the math doesn't work. So the pension funds have assumed, a lot of these pension fund guys, yes, they have a large amount of capital, but they don't have anywhere near the amount of capital to meet the obligations for everyone to have a very cushy retirement at the levels that the politicians promise the retirees in exchange, or the people who are running the pension funds and voting for them. Well, the government employees, teachers, firemen, policemen who were putting money into the pension funds, who were told that they were going to get nice retirements with the pension fund. So the pension funds needed, a lot of these pension funds needed 8% per year compound annual growth rates. And that was how the math would work out, so everyone could get a nice fully funded retirement. And most of these pension fund guys, most of these pension funds have gotten 1% returns per year, 2%. So it's going to create an even worse problem if the U.S. does go to ZIRP, zero interest rate policy, and that looks likely. Now, NIRP, negative interest rate policy, I'm not sure if the U.S. will go for it. There are people inside the Federal Reserve that are calling for it. There are some economists that are opening up to this now, but that would start to really destabilize the insurance companies, because insurance companies and some pension funds, but mostly insurance companies, are legally required to buy here in the United States bonds, especially treasuries and government bonds. So if insurance companies are not getting good returns, then their insurance companies take in, if you're not familiar with the business model, insurance companies collect premiums. People pay in premiums for different types of insurance, and then the insurance company is supposed to reinvest those premiums and get a larger return than people collecting on claims. And that's how the insurance company remains profitable. It's called the float. So when people pay in, Warren Buffett built Berkshire Hathaway on getting insurance money the premiums. And then he took in those premiums from the Berkshire Hathaway's ownership of Geico and other insurance investments and other reinsurance companies, and he reinvested those during a stock bull market for decades, and that's how he made so much money. Because he was taking in his cost. Most people aren't aware of this, but at the time, for decades, Warren Buffett, when he was initially taking in the insurance money, the insurance premiums with Berkshire, his exposure in the reinsurance companies and Geico, he was getting, his cost of capital was unbelievably cheap. It was almost like central bank level cost of capital. And then he would reinvest that in stocks, and then that's how he would compound his wealth over the long term enormously. So, to answer David's question more, how would this affect pensions? I think it would exacerbate the underfunded pension problem even worse. All you have to do is look at how bad the pension funds are in the European Union and how bad the insurance companies are in the European Union. Because the European Union has been experimenting with negative interest rate policy for longer. Same thing in Japan. So, thank you for the question. What will negative rates mean for commodities? This is an excellent question. I think negative rates for gold, silver, platinum, and maybe palladium are good, and they're not good for base metals, for copper, iron ore, steel, very bad. Unless President Trump were to announce with these lower interest rates that are being manipulated down, corresponding infrastructure bonds. So what may be happening then is Trump is also planning, because he talked about issuing 50 and 100-year bonds, is planning these infrastructure bonds where some people in their retirement accounts, in their 401ks or IRAs, they will be required to buy either U.S. Treasuries or infrastructure bonds at an artificially low interest rate to fund new infrastructure here in the U.S. Now, it sounds good, but remember what happened with President Obama. Remember, President Obama sold us, as soon as Obama took his first term, in the first 100 days, that he had all these shovel-ready projects, and I think, $800 billion was wasted? I don't remember any of those shovel-ready projects being effective. I don't remember any of the infrastructure. That money, if it was spent at all, and I'm not sure exactly how much of the money was spent, if all of it was spent, but the money that was spent was entirely wasted. So I could see a scenario where they force the central bank, and with President Trump at the helm, if he's still there for his second term, where they force the interest rates down, and then they require people to invest their part of their retirement, maybe 1% or 2% to start, that's getting the camel's nose under the tent. That's normally how government programs are. So it's a temporary, they'll say it's a temporary program. We need infrastructure for jobs. We need to fix infrastructure. What was already announced? Yeah, so I think, guys, the bottom line, the largest pool of capital remaining that the government can go after here in the United States is people's retirement accounts. So the last estimate I saw was around $19 trillion total in people's 401ks, IRAs, government employee retirement plans, teacher retirement plans. That's a large pool of capital, $19 trillion. Now, a lot of that is in bond funds. It's attached to treasuries through pensions in the U.S. Treasury market and also in the stock market. A lot of it has been indexed in the index funds, and I talked about the problems with the index funds. The index fund market was not designed to be this large, and eventually the index funds may own 50% of all the large cap stocks. It's heading that direction. But they were not designed, index funds were not designed to be this large and control all this many shares of large cap stocks. I hope Trump doesn't get negative interest rates. That would be really bad. Of course, as interest rates are going down, the corporations and these zombie corporations, they will continue to play the refinance game, and they will continue to borrow more money. They will continue to lever up their balance sheet. The analysts covering these companies will talk about EBITDA. Yeah, I could see. So China is slowing down. China's slowing down a lot. Whether you think China's going to collapse or not, you can't argue that China is not slowing down. They're slowing down a lot, and that will put... Someone was asking me, how do I short China? I think China's going to be buying a lot less copper from international metals markets, a lot less iron ore, a lot less base metals. They're going to be buying a lot less of that. China has already launched infrastructure spending, Carp. China's been doing that for 10 years, over 10 years. It's been nonstop infrastructure. This is why you get waste. There was an article that came out last month that the Belt and Road Project, so much money was being wasted that the Belt and Road Project, the Chinese government, was being scammed by contractors and others, that they were sending empty train cars on the Belt and Road Project to overcharge the Chinese government. China has been nothing but infrastructure for 10 years. You're saying that China needs to do more infrastructure? What they need to build even more bridges to nowhere and more roads to nowhere? There's a lot of those now. Those are make-work jobs programs, a lot of them. There are some useful infrastructure projects, but also a lot of waste. No one can bail out the central banks. Jim Rickards says that the IMF will. I disagree with him. I think we're going to have a new global financial system probably in the next couple years. Some type of reset. I don't know what it's going to look like. Either a new global financial system or a reset or something. Yeah, but who says Trump is here after 2020? We don't know. It looks like he has a good shot for a re-election. I didn't vote for him in the first election, but it looks like as of now, he has a good chance at a re-election, but we'll see. They won't go to Bitcoin. Thank you for the super chat. Thank you, Greg, for the super chat, and thank you, Askors, for the super chat. A Bitcoin standard? No, it would be a Fed coin, with China's already announcing that they want something like Libra, that the government's going to use that. The government's going to have the large corporations help them implement more tracking and taxing of transactions with their integrating with their social credit score. Okay, so let me talk about this funny thing here, this story from a couple days ago. So this was before the Trump tweets yesterday about negative interest rates. So JP Morgan made a Volfefe index. So instead of Covfefe, remember his typo? It was everyone still talks about Covfefe. So they this is a riff. It's called Volfefe, Volfefe index to track how Trump tweets move the bond market. Here's what it shows. So a single tweet by President Trump helped bring home the bacon for bond investors in August. Indeed, the bond market roared higher last month. This article is by Barbara Kohlmeyer, a markets reporter for MarketWatch. Indeed, the bond market roared higher last month, sending yields down. Notably, although now yields are up, probably because the trade is being unwound, like I said, because it was with leverage, the zero interest rate policy trade that Stanley Druckenmiller told other people about, and then other people copied him with leverage, and then also all these treasury auctions that are coming up, massive amounts of them. Even though the dollar hasn't gone down yet, I think it's good that gold is still holding above 1,500. Shows that maybe some of that money, because people were asking me, well, where does that money go that the hedge fund managers, after they unwind the Stanley Druckenmiller trade, that they copied him with leverage, where does it go? And I was saying, well, some of it would probably go into physical gold. You may not see that in the paper gold price. Because remember, buying a physical gold a lot of times does not affect the paper price initially. Now, over longer periods of time, if there's large buying by central banks at certain price points, or the miners run out of economic metal at certain price points, then that is what would move the price higher. Or the dollar starts to really tank, then gold would probably really take off. I think probably someone asked me about, emailed me about where I see gold correction. I think we could still see 1600, 1650 gold by the end of this year, but we might go in the short term, we might go a little bit lower. But as these treasury auctions come, guys, that's probably going to mean that people are going to start to become more wary of the dollar. As more and more treasury auctions come, we'll see. So I'm not going to be one of those people in the gold community that's taught. There's still people in the gold community that for the last 3 months, I've just been seeing them post stuff on Twitter about, oh, now the dollar is definitely going to collapse. And, it's only, it's within weeks, it's within months. It's not going to happen. Not that short a time frame. And anyway, those people, you have to look at the track record of some of these people making predictions like that. Some of these people making predictions have been saying the same thing for 10 years. It's every couple weeks or couple months that it's a collapse. There was one or two experts out there that were saying, everything was done, and they gave a specific date and time, a specific date in June and July. They said everything is done by June and July. And here we are, we're in September and everything's not done. And yet people are still believe these guys. Okay, let me continue with the article now. So what are his tweets really doing for the U.S. markets? Okay, I lost track of where I was in the article. Indeed, the bond market roared higher last month, sending yields down, notably after President Trump pledged to impose tariffs on all remaining Chinese imports, and as his Twitter activity picked up the pace. So what are his tweets really doing for the U.S. rates markets? That's what JP Morgan's Volfefe index. It's just funny saying Volfefe. A play on that Trump Covfefe typo from 2 years ago aims to find out. Munir Salem, vice president of the bank's U.S. interest rate derivative strategy, and his team created the index to gauge how Trump tweets. Oh, so Trump has done 10,000 approximately tweets since he took office in January of 2017, have influenced moves in implied rate volatility for 2-year and 5-year Treasury notes. And they have the symbols there. And they have charts. In the article, the index explains a measurable fraction of moves in implied volatility, particularly in shorter tails, that is the 2-year rates and 5-year rates, as opposed to 10-year rates. Digging into the Twitter stream, they say the most impactful tweets have focused on trade, with those mentioning monetary policy or of lesser influence. China, billion, and products, so those are the 3 keywords, were among words topping the list on those market-sensitive tweets. So those are the high-frequency trading algorithms that are reacting and trading on his tweets. Their model finds out that around 4,000 non-retweets occurring during market hours from 2018 to present, only 146 moved the market, and quality is not quantity, as they note that the Volfefe index, quote, strongly outperforms the sheer tweet count in periods headed into substantially elevated implied volatility. The bank's research follows a report from Bank of America Merrill Lynch last week that found if Trump stays off the Twitter platform, the stock market fares better. It's funny. No, negative rates is an attempt to weaken the dollar. This goes back to Keynesian economics. They're trying to force you to not save. They're trying to force you to spend. But the unintended consequence of that is money velocity could pick up. So right now we have stagflation, but money velocity is at record lows. So that means they pumped still all these central banks, whether it's in China, the European Union, or the U.S., they pumped an extraordinary amount of money and credit into the system, but there's just not a lot of money velocity right now. Money velocity would be what would take things from pretty bad stagflation now to much worse stagflation, and then potentially even to hyperinflation. Well, they're trying to weaken the currency. The U.S. wants a controlled devaluation of the dollar. Everyone, whether it's at the Federal Reserve, at the U.S. Treasury, Republican or Democrat, everyone wants a controlled devaluation of the dollar. No one wants the dollar to collapse. Since we went off gold, yes, any money system is about faith, or about the U.S. military. Kyle Bass is a billionaire, and you're wasting your time insulting him. All of his information is biased and telling fairy tales. He's a billionaire. He made some amazing trades. He was very poor. If you know anything about his life history, he grew up very poor. He had to earn his way for a college scholarship. It's a really impressive story. Look, Kyle Bass is not always right. He does make mistakes. A lot of professional money managers make mistakes pretty frequently. That's just ridiculous. Have some respect for people. Kyle, I don't think it was a dude. I think it was a chick. But maybe it was a dude pretending to be a chick. Just that he's wrong about everything. He lies and tells fairy tales, and that anyone who listens to Kyle Bass or listens to my channel is suicidal and a bunch of other bullshit. Which is funny, because yesterday or the day before, that person was actually telling me they were going to sign up for my Patreon. I remember in the comment section. So either they just totally went bipolar, or they have very serious other mental issues. Anyway, I don't want to waste any more time talking about trolls. So take a look at listener questions and comments. I'll keep this to a much shorter stream today. Thank you, Eric, for the super chat. Thank you, Jim, for the super chat. I appreciate it. I should do another show in the next couple days about the oil market, because there's a lot of stories that are coming out about the oil market that the bear market is going to get worse. Especially here in the U.S. oil producers. And then also the signs that the recession, the official recession in the U.S. is going to be called, they're going to call it a recession probably in 12 months or less. Maybe if Trump kisses up to the Fed, maybe the Fed will print enough to keep things propped up until after the 2020 election. Patreon just diversifies my ad revenue, so YouTube can't decide that they take it all away, because that's happened in the past. No, I haven't done any podcasts on airline companies. In general, airlines are really bad businesses. Airlines have very high capex. Airlines are not consistently good businesses. You can make money trading airlines, but I would not be a long-term investor in an airline, especially American companies, American airline companies. I mean, look at the customer service ratings for like United, American, Delta. They're absolutely horrible. Why not just fire Powell and put his puppet in charge? Sasha, because he has to get congressional approval. Trump couldn't even get Herman Cain or Stephen Moore through. And I think Judy Shelton is probably not going to get through either, because Judy Shelton has said too many nice things about gold. Tracy says we have a lot of shale oil, not shell oil, but you can't make diesel from it. Yes, that is part of it. The other part is shale is not economic. You need cheap debt, and shale companies other than EOG Resources seems to be the only shale producer that's efficient, that can consistently generate free cash flow and lower their costs. I was just looking at EOG before the show for a while, and they look to be in pretty good shape, but I still wouldn't buy them here because I think the oil market, they have earnings per share and free cash flow, but the oil market looks like it's in a bear market to me, which means that there could be a lot more bankruptcies and the oil price could go lower in the short term. Yeah, shale is priced with WTI, but it's discounted because there's transportation costs involved. I believe it's slightly discounted. Oh, I would love to end the Fed, but I don't think it's going to happen. Not when Ron Paul's called a crazy person, and, Rand Paul is routinely insulted all the time, too. When will the shale oil go bust in the U.S.? It depends on the oil price. It depends how much capital can the shale oil companies raise, how quickly can they cut costs, and what the oil price is. So those are the three main factors. And shale oil companies can't raise a lot of capital right now. A lot of them can't. The oil price could go lower because of the global economy is slowing down a lot. And then shale oil companies are cutting costs, though. It looks to me like they're doing a pretty decent job cutting costs. The problem is if oil price goes lower, they're not going to be able to cut costs faster than the price is going down. This is a situation which happened to gold and silver miners and why gold and silver miners almost went bankrupt. Oh, guys, by the way, if you want to do your own research for gold and silver miners, coming up this week is the Denver Gold Forum. So you can go on the website and you can watch the presentations for each company on there. They're free. So they'll be on the website, on the Denver Gold Forum website. So you'll be able to get the most up-to-date information and PowerPoint presentations there. So if you're in the Colorado area, in Beaver Creek or Vail area, I think that's where the conference is. All the mining CEOs will be there. Normally, there's a lot of mergers and acquisitions that are done at the conference. There's a lot of investments into juniors by the larger miners there. So I think we could see pretty shortly coming out of that conference, maybe within a month or less, maybe some deals. Patriot Star says the dollar is starting to hyperinflate. The dollar is not starting to hyperinflate. Okay, there has to be money velocity. You have to see foreigners start to dump the dollar rapidly, which is not the case. There's a demand for dollars, especially for countries with dollar-denominated debt. China has a legitimate dollar shortage. You will see the money velocity pick up. You'll see U.S. consumers not want to save dollars. You'll see them dump dollars then. There is no evidence that hyperinflation is imminent for U.S. dollars. I'm not saying it won't happen. I'm saying it's just not going to happen anytime soon. That's the euro. For Mario Draghi QE to infinity, that's the euro. And that would mean a stronger dollar. The U.S. is not doing QE to infinity. I don't know where you were told this stuff. The U.S. hasn't restarted QE yet. So if the European Central Bank does QE to infinity, and they do rate cuts and they do more negative interest rate policy, that's going to weaken the euro. That's going to mean a stronger dollar. Now, that's going to mean probably that European banks are in more trouble, that European corporations are in more trouble, and emerging markets are in more trouble with a stronger dollar, and China. Email me the article. I didn't see it, but the balance sheet doesn't look like it increased massively. What is the gold community talking about? How, oh my god, the gold community is blowing this out of proportions. Even if they restarted QE and the balance sheet increased, the balance sheet's not at 5. It didn't go from 4 something trillion to 5 trillion, 6 trillion, 7 trillion very quickly yet. We have no evidence of this yet. No real proof. Now we know what the off balance sheet stuff is, and we know I report on this with the Fed with the currency swaps. Guys, the dollar index is holding above 98. Okay, if people were aware of this information, if a lot of this stuff was really true, the dollar index would start to devalue further. Why is the dollar index holding above 98? And the answer is simple, because on a relative basis, emerging markets, the European Union and China are in worse shape than the US for now. That may change, but for now, the US, on a relative basis, the dollar and the US economy is the cleanest dirty shirt in the laundry basket. Not everything is rigged. No one told emerging markets to go and borrow an extra $6 or $7 trillion in the last 8 years, betting that the dollar would collapse, and then it didn't. Okay, what you guys don't understand is there has to be a psychological component for hyperinflation. There has to be a psychological component where people decide they, at any cost, they will not hold the currency. Go back and read through financial history, and people decide at any cost, okay, so Venezuela is the best example of this. People decide at any cost that they do not want to hold the Venezuelan bolivar or the Zimbabwe dollar. Okay, that's what a hyperinflation, there is nowhere close right now to a hyperinflation. There has to be a psychological component where the people decide as soon as they get paid in the currency, they have to go buy groceries, they have to go buy something at a store, they have to store it in anything else but the currency. The currency has to be dumped for something else of value. Bitcoin, gold, food, grocery store items, consumer staple items, boxes of cereal, anything immediate, toilet paper, anything immediately. Barrels of oil, anything. So there is... The people who are telling you hyperinflation right away, they don't understand hyperinflation. They haven't studied financial history. Yes, the dollar may hyperinflate in the future, but it's not imminent at all. Guys, it's more likely that China will hyperinflate first. You know why? Because there's a lot of people in mainland China with RMB savings who want to get out of the currency immediately, and that's why China has capital controls in place. They're trying to prevent it. China has created, since 2008, more than double the amount of money supply. I'll talk about this again. Helicopter money drop. There was a Zero Hedge story on it. More than double the amount of money supply of the US, the European Union, and Japan combined. Everything can't be rigged. Some things are more rigged than others. But everything can't be 100% rigged. I can't believe people are saying this. Look, guys, if you're going to be annoying, it's just... No, I think Peter Schiff is a brilliant guy. I just think he's 100% wrong on China. He actually supposedly admitted that there's problems in China yesterday or the day before. He said it in one sentence. I'm aware of the missing 21 trillion. I covered it as soon as Catherine Austin Fitts did it. Are you American? Do you just hate the U.S. more? All the other countries are doing the same thing. They all lie and cheat. It's the dollar index. Most of the dollar index is made up of the euro, 60%. So if there's a weak euro, it has to be a strong dollar. If there's a strong euro, it has to be a weak dollar. Look, all these governments are lying and cheating and doing what they have to do to confuse people and trick people. CalPERS, is that CalPERS Treasury Holdings, Eric? Because CalPERS, I think, has well over $1 trillion in assets under management. I think that 400 billion number you're quoting is probably their Treasury holdings. They have large amount. Guys, the large banks, the large U.S. banks, the primary dealers, they have, I think, over $300 billion in U.S. Treasuries. And Victor Sperandio, remember I interviewed him last year. Go in the archives on my channel if you're not familiar with this. Go in the archives and listen to the interview about how the large banks got the rules changed at the Fed a number of years ago, and they can hold those treasuries to maturity and not have to write down any losses. It's called HTM accounts. We don't know. Draghi's leaving the European Central Bank soon, so we don't know what the next Christine Lagarde, we don't know if she's going to copy him. Draghi was lying and claiming that there was a consensus about the rate cuts in QE, and it's not true. So there was more diversity, quote, there was more diversity of views on APP, but then in the end, a consensus was so broad that there was no need to take a vote, Draghi said. But it's just not true. He was lying about that. Bloomberg is reporting that in an unprecedented revolt, ECB governors representing the top European economies defied Mario Draghi's ultimately successful bid to restart quantitative easing, according to officials with knowledge of the matter. So there's a fight inside the ECB, and that's because they're trapped. They know that their policies are not working. My friend Daniel Lacalle has 2 good articles about this from earlier this year. I'll read you the titles, and I'll put the links in the information section after I shut down the live stream. The articles are: negative rates have damaged banks, but that is not the worst effect from June 25th of 2019. And then the ECB continues to incentivize reckless behavior from June 8th of 2019. Very good articles about problems with the European Central Bank. But this all goes back to Japanification. All these major governments now are all trying to copy Japan, even the emerging markets. Even the emerging markets are cutting rates and doing QE. Although the problem with the emerging markets now is the dollar-denominated debt, net capital outflows. I've talked about this on videos. Go back in the archives in the last couple weeks or a month. I think it's clear that we have a bear market in oil, that things are probably going to get worse, barring something unforeseen that happens. Maybe OPEC actually does an enormous production cut. It's not likely, though, because the OPEC countries, so many of them need oil revenue. I think base metals and oil could have a very big bust in the next couple years. I think Trace Meyer put... Here's a question here from Harmony. I don't share my buddy Trace Meyer's optimism for Bitcoin. Why not? Trace put, I think, all of his, or almost all of his savings into Bitcoin now, a while ago, and I don't think he sold out of it. He sold much out of it. I'm more about diversification. So I'm not going to put all my money into any one thing, all my savings into any one thing. It's not all going into Bitcoin. It's not all going into gold, not all going into silver. I think it's dangerous to bet everything on one or two things. He's extremely wealthy. Congratulations to him. He doesn't need to work another day in his life if he doesn't want to. He doesn't have to work a job he hates. But other people who did that and mistimed that trade, they lost. Other people have done that in the Chinese reverse mergers. Those stocks, some people lost all their life savings. They got China hustled. Yeah, I have some dollars. But that's in case of a stock market crash. The dollars are just there for liquidity for a stock market crash. So if things that are good, like good assets, good stocks go on sale, you can buy those. I have cash for opportunity. It's called for optionality. Joe asks, if they copy Japan, can they continue the game another 20 years? It's a very good question, Joe, and I think the answer is no, because Japan got away with it for so long because they were the only country doing it for a while. They've been doing it for over 30 years, and now all the major countries are trying to do it. So you have now all these countries trying to copy Japan, and Japan was able to move a lot of their inflation, their monetary inflation. It was able to be exported out of Japan and into like US stock markets and other markets. That 50-year treasury bill may be part that's being proposed, maybe like those infrastructure bonds that I'm talking about, but who knows if the government can actually develop good infrastructure anymore here in the US, because look at all the corruption and the problems. Look at what happened with Obama's shovel-ready projects. They didn't work out. That was what, $800 billion? Worth of approximately of shovel-ready projects. I'm not sure if they spent all the money or not, but a lot of it got wasted. There was like the bridge to nowhere and all that other stuff. Someone email me the article about QE restarting secretly that Zero Hedge ran. I'll take a look at it. I didn't see that. I must have not seen it. I've been covering so many articles and videos. But I'm wrapping things up here, guys. I'm getting tired. Thank you very much to my almost 150 Patreon account contributors and my almost a dozen monthly PayPal contributors. If you chip in once in a while, thank you very much, too. I just got half a Litecoin donation, or almost a little more than half a Litecoin donation recently, a couple hours ago. So thank you very much for that. Okay, guys, bye for now.